There are 67 million square feet of warehouses, distribution centers, and industrial facilities in the United States right now that belong to one company, not Amazon, not a freight carrier, a Chicago-based real estate investment trust that you probably have not thought about once this year, and that is, quietly, one of the best-positioned businesses in the American logistics economy.
First Industrial Realty Trust, ticker FR, Industrial REIT. Q1 2026 revenue of $183.5 million beat the $182 estimate. GAAP EPS of 37 cents beat the 33-cent estimate by 11%. Core FFO per share of 69 cents beat the 65-cent estimate. And management just reaffirmed and slightly raised full-year guidance.
Today on Charged Alpha, we are covering the warehouse behind the warehouse, the company that owns the buildings that move your packages, store your grocery orders, and house the supply chains that keep American commerce running. FR is trading near its 52-week high at a P/FFO multiple of about 23 times. That is not cheap. But as we will get into today, there is a very good reason the market pays up for infill industrial real estate, and an equally good reason to understand the risks at these levels. Let us go. Section 2, Company Overview. Lana, walk us through what First Industrial actually is.
FR is a pure-play industrial REIT, real estate investment trust, focused entirely on one property type, industrial. No office, no retail, no residential, just warehouses, distribution centers, and light industrial facilities. They own and operate approximately 67 million square feet across the United States, with the heaviest concentration in Southern California, Chicago, Northern New Jersey, Atlanta, Dallas, the SF Bay Area, Seattle, and South Florida.
Why does the location matter so much for industrial real estate?
Because the value in logistics real estate is not just square footage, it is proximity. A distribution center in the Inland Empire of Southern California, 15 miles from the Port of Los Angeles, is not the same asset as a warehouse in rural Indiana. FR focuses heavily on what the industry calls infill locations, properties close to dense population centers or major logistics nodes, where the supply of developable land is genuinely constrained by zoning, environmental requirements, and cost. That scarcity is the core of the investment thesis.
And they are not a passive landlord. They build things too.
Exactly. FR has an active development platform. They both acquire existing industrial buildings and develop new projects. The development pipeline is currently about $350 million in projects either under construction or in active lease-up. They build, they lease, and then those stabilized assets contribute FFO. The company was founded in 1994 in Chicago, and it has spent 30-plus years building this network of infill industrial assets that are genuinely difficult to replicate. Section 3, CEO background.
Who is running this company?
Peter Bacci, President and CEO since 2016. He joined First Industrial in 2011 as CFO, was promoted to President in 2015, and took the CEO chair the following year. Before FR, he spent over 2 decades in real estate investment banking and advisory, including roles at CIBC World Markets and Jones Lang LaSalle. He is not a real estate operator who moved into finance. He is a finance mind who runs a real estate operating platform, and that distinction matters in how he allocates capital.
What is his reputation in the sector?
Highly regarded for discipline and consistency. His signature contribution has been sharpening FR's focus on high-barrier infill markets and using the development platform to generate FFO growth above what pure acquisition would achieve. The development spread thesis is central. FR builds at yields of 6 to 7% in markets where stabilized cap rates are 4.5% to 5.5%. That gap is real cash-on-cost accretion, and Batchel has communicated it clearly enough that the market has consistently rewarded the strategy. Section 4, the numbers.
Lana, give us the numbers on this one.
I want to start with valuation, because with a REIT, the standard metrics do not tell the whole story. The stock is at $62.89, 52-week high of $64.66, which means we are nearly at the peak. 52-week low was $46.51, so the stock has run 35% off its lows in the past year. GAAP P/E is 33.7 times. That looks rich, but GAAP earnings for a real estate company are understated by depreciation of physical assets, which the accounting requires, but which does not reflect economic reality for buildings that tend to appreciate.
That is why you use FFO for REITs.
Right? Funds from operations, FFO, adds back real estate depreciation and amortization to net income and excludes gains or losses on property sales. It is the industry standard for understanding a REIT's true earnings power. On an estimated core FFO basis, FR trades at about 22.9 times, which is a meaningful premium to lower growth industrial peers like STAG at 13 to 14 times, but roughly in line with East Group and at a slight discount to Prologis.
What are the revenue and cash flow numbers?
Revenue on a trailing 12-month basis is $727 million, growing 8.1% year over year. Operating cash flow on the same basis is $483 million. That OCF per share of $3.64 is what ultimately funds the dividend, the development pipeline, and any debt reduction. The gross margin is 60.2%. NOI margin, net operating income as a percent of revenue, is 72.1%, which is strong for the sector and reflects the low operating cost nature of industrial leases, where tenants pay most property expenses directly.
What is the balance sheet situation?
Cash of $78 million against total debt of $2,573 million, net debt of $2,495 million, net debt to EBITDA of 4.5 times. That is meaningfully below the industrial REIT average of 5.5 to 6 times. Total assets of $5.7 billion, stockholders' equity of $2.7 billion, interest expense running about $90 million annually. ROE is 9.3%, modest for a non-REIT company, but appropriate for a capital-intensive real estate operator. The more important return metric is cash yield on development cost, and Bachil consistently delivers that at a positive spread to cap rates. Overall, First Industrial's financial health is solid. The company generates $483 million in annual operating cash flow, maintains conservative leverage well below peers, and has a visible earnings growth path from its development pipeline. The main watch item is industrial vacancy trends in core markets and the trajectory of renewal rent spreads. Section 5. What the Street Thinks.
What does the analyst community say about this one?
12 analysts covering the stock, 6 buys, 5 holds, 1 underperform. Consensus is moderate buy. Average price target of $70, that is about 11% upside from current levels. Target range runs from a low of 58 to a high of 85. Raymond James has an outperform rating, citing the development pipeline and rent spread momentum. Baird is buy, focused on infill land scarcity as a durable moat. Goldman Sachs is neutral. Their concern is that vacancy headwinds will moderate FFO growth below the market's current expectation. KeyBank is buy. UBS and RBC are both neutral to sector perform.
What about Q1 specifically?
Q1 was a solid beat on every metric. Revenue of $183.5 beat the $182 estimate. EPS of 37 cents beat by 11%. Core FFO per share of 69 cents beat the 65-cent estimate, a 6% beat on the metric that actually matters for REIT valuation. Management reaffirmed 2026 core FFO guidance at $285 to $295 per share and raised the revenue midpoint by $5 million. That guidance raise is modest but directionally meaningful. It signals that management sees the leasing environment as stable to improving, not deteriorating. Section 6. The Bull and Bear Case.
Let me run the bull case for FR. The single most important thing to understand about the FR bull case is what rent spreads tell you. When FR renews a lease, they are repricing a tenant's occupancy to current market rates. In 2025, those renewal rent spreads ran 40 to 55% above expiring rents. That means tenants who signed leases in 2019 or 2020 at, say, $6 per square foot are renewing at $8.50 to $9. You do not need new buildings, acquisitions, or speculative development to generate that growth. It is already embedded in the lease expiration schedule. Even if market rents flatline from here, FR has years of compounding mark-to-market embedded in its existing portfolio. The second tailwind is the development machine. FR has $350 million in projects either under construction or lease-up right now. They build at yields of 6 to 7% in markets where stabilized industrial assets trade at cap rates of 4.5 to 5%. That is a 150 to 250 basis point spread that converts directly into core FFO accretion as projects stabilize. And at 4.5 times net debt to EBITDA, they have room to continue developing or acquiring without equity dilution. Third, the trade policy tailwind. There is an argument that tariffs and nearshoring trends accelerate domestic supply chain investment, increasing demand for industrial real estate in port-adjacent and major logistics hub markets. FR is heavily concentrated in exactly those markets.
Now, the bear case. Industrial vacancy rates have risen from historic lows of 2 to 3% in 2022 to 5 to 7% in many core markets by early 2026. The construction boom of 2022 through 2024 delivered substantial new supply into markets that were already absorbing record e-commerce-driven demand. And when that demand normalized, vacancy jumped. In markets like the Inland Empire and Chicago, two of FR's largest exposures, availability rates are at multi-year highs. If vacancy continues to rise or stays elevated, the 40 to 55% renewal rent spreads investors are counting on will compress. The second bear case is simple math on the premium valuation. At 22.9 times FFO, FR is pricing in sustained above-average growth. Stag Industrial, a comparable industrial REIT with lower barrier markets, trades at 13 to 14 times FFO. The premium is justified if FR's infill advantage is durable, but if market rents plateau and the development pipeline slows, the valuation has nowhere to hide. And the interest rate environment matters. Higher for longer rates pressure cap rates, which are the inverse of asset values, and raise the cost of FR's ongoing development financing. If refinancing costs rise materially when the $300 million in short-term debt comes due, interest expense will clip FFO per share growth. Section 7. Peer comparison.
How does FR compare to its peers in the industrial REIT space?
The logical comps are the four major pure-play industrial REITs: Prologis, Rexford Industrial, East Group Properties, and Stag Industrial. On a P/FFO basis, the spectrum runs from Stag at 13.8 times all the way to Prologis at 23.1 times. FR at 22.9 is near the top, between East Group at 22 times and Prologis.
That is a big range. What explains it?
Market quality and growth rate. Stag is diversified across secondary and tertiary markets, lower barriers to entry, lower rent growth, lower premium. Rexford is pure Southern California infill, extremely high barriers, historically very strong rent growth, but concentrated geographic risk. East Group is Sunbelt focused with an active development engine, strong growth, increasing barriers as Sunbelt markets tighten. Prologis is the global giant, 4 times the size of FR, operates in every major logistics market globally, and commands a perpetual premium for scale and liquidity. FR sits in the top tier because of infill positioning and the development spread, but the question is whether the premium to East Group and discount to Prologis is correctly calibrated. Section 8. Options activity.
Options picture on FR.
Formal put/call data was not available for this episode, but we can characterize the setup. FR's beta of 1.13 means it moves in sympathy with broader REIT and equity sentiment, slightly amplified. With the stock approaching its 52-week high into earnings, the options market typically sees call interest from traders positioning for a guidance raise catalyst and covered call selling from existing long holders who want to clip income near the peak. The Q1 beat and guidance reaffirmation sets up Q2 as a catalyst-clear quarter, which tends to reduce implied volatility. Income-oriented investors may find cash-secured puts in the $58 to $60 range attractive for establishing a position with a margin of safety from current highs.
A REIT near its highs with a development pipeline story tends to attract systematic covered call writing.
Exactly. FR's 1.5% dividend yield is modest for a REIT, but the options premium on covered calls can supplement income meaningfully for long holders near multi-year highs. Section 9. Insider activity.
Any insider moves worth noting?
No open market purchases or sales have been recorded in the recent period. Management alignment at FR operates primarily through equity compensation. performance-based RSUs tied to FFO per share growth and total shareholder return relative to REIT peers. The REIT structure requires distributing 90% of taxable income, which limits retained cash available for insider purchases, so the alignment mechanism is equity grants rather than open market buying. The long average tenure of the executive team suggests alignment through long-term equity stakes rather than short-term trading activity.
That is a common structure for REITs. The dividend requirement means most insider alignment has to be through equity grants rather than stock purchases. Section 10, Risks and Watch Points. What are the key things to watch going forward?
3 specific watch points. First, renewal rent spreads. FR discloses the spread between expiring leases and new lease rates quarterly. If this spread begins compressing from the current 40 to 55% range toward 25 to 30%, the same store NOI growth story weakens materially. Second, development pipeline stabilization. Watch for management commentary on whether projects under construction are signing tenants ahead of, on, or behind schedule. Any push-out in lease-up timing converts directly to FFO timing risk. Third, the industrial vacancy trend in Southern California and Chicago. If availability rates in those 2 markets continue rising, FR's portfolio-level occupancy, currently around 96 to 97%, could slip toward 94%, which is the threshold where renewal pricing power typically softens.
And the forward catalyst?
Q2 earnings. The second quarter is when the summer leasing season kicks in, and FR's Sunbelt and coastal markets see the highest leasing activity. If Q2 same-store NOI and renewal spreads hold at current levels, the bull thesis gets a strong data point. If they begin to compress, the bear case picks up traction. Section 11. The bottom line.
Let us land this one.
First Industrial Realty Trust is a high-quality industrial REIT trading near its 52-week high at a 23 times FFO multiple. The premium is earned by the infill land moat, the active development engine, and the embedded rent spread growth still compounding through the existing lease book. The Q1 beat and guidance reaffirmation confirm the business is executing, and the balance sheet, at 4.5 times leverage, provides optionality. The risk is that the elevated valuation does not give you much room for error. If industrial vacancy continues to rise, or rent spreads compress faster than expected, 23 times FFO becomes expensive.
The central debate on FR is whether the infill premium is truly durable or whether the post-pandemic normalization of industrial demand will eventually equalize rent growth across market tiers. The data through Q1 supports the premium, but the rent spread trend over the next 2 to 3 quarters will tell you a lot about where this goes.
The key metric to watch: core FFO per share growth and same-store NOI growth rate. Together, they tell you whether the development pipeline is accretive as planned and whether the embedded rent marks in the lease book are holding up. Watch particularly for management commentary on renewal spread guidance for the remainder of 2026. Section 12, closing quote, CTA.
We will leave you with CEO Peter Baxel from the Q1 2026 earnings call. We delivered a strong start to 2026. Our markets remain fundamentally well-positioned, our development pipeline is on track, and we are seeing continued demand from customers who value the location and quality of our buildings. We remain confident in our ability to grow core FFO and create long-term value for our shareholders.
Well-positioned markets, on-track pipeline, confident guidance. That is a CEO saying the business is running as designed. Whether the market's 23 times FFO multiple proves prescient or generous depends on what happens in that industrial vacancy data over the next 2 to 3 quarters.
That is going to do it for this episode of Charged Alpha on First Industrial Realty Trust, ticker FR. And hey, if you want to run the same research workflow we use to build these episodes, everything is free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I am Hudson Thomas. Section 13, Outrow Required Disclosure.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk. including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.